All right, if you're here right now, you probably felt it already. Something just snapped in the silver market, and it didn't happen slowly. It happened in hours. In the last couple of hours, Western silver prices ripped through $121 an ounce, while China kept trading north of 146. Let that sink in. That's a historic gap opening in real time. And here's why you should care. This isn't just price action. This is market structure breaking. Stay with me, because I'm going to show you what just decoupled, why it matters for your money, and how you can spot this kind of stress before it hits headlines. If you're watching this now, you're ahead of tomorrow's panic. Your job is to understand what's actually happening while everyone else is still scrolling Twitter trying to figure out if it's real. Now, before I explain what caused this, let me teach you something most people never really internalize. When you see a commodity price, you're usually looking at paper first and physical second. Futures, ETFs, contracts, promises. Think of it like airline tickets. You can sell a lot of seats on paper, but if the plane only has so many seats, eventually someone gets bumped. Silver works the same way. The paper market trades velocity and leverage, but the physical market trades scarcity. When those two drift apart, the market is telling you something is wrong under the hood. And right now, that warning light is flashing bright red. So what does that tell us? It tells us we're not watching a normal price move. We're watching the gap between promise and reality get too wide to ignore. If this is making sense, drop a comment below. Tell me if you've been watching this build, or if you're just catching up now. I want to know where you're coming from. Now here's what's actually happening. Let me break down the sequence so you can see how all the pieces fit together. First, physical supply has been tightening for years, not months. We're talking persistent global deficits, industrial demand from solar and tech that never really slowed, and inventories quietly bleeding out. This isn't sudden, it's been building. Second, refiners like the Perth Mint and Metalor halting new orders didn't just happen for optics. That's supply chain stress surfacing. When refiners pause, premiums explode, and suddenly the metal you thought was available isn't available at any price you expected. You call up your dealer and they're telling you 4 weeks, 6 weeks, maybe longer. That's not normal. Third, China is bidding aggressively for physical silver, and they're willing to pay up. That's why Shanghai spot is sitting nearly $25 above Western prices, and futures in China are printing $146. That convergence is the key. Paper prices stay capped in the West, while physical clears at much higher levels elsewhere. So what's driving China's demand? It's not just speculation. They're securing physical metal for industrial use and strategic reserves. Solar panel production alone requires massive amounts of silver, and China dominates that space. They're not playing paper games. They're buying real metal for real production. And when you've got the world's largest manufacturing base competing for a finite resource, prices adjust. But here's what's interesting. Western markets are still operating like there's plenty of supply. Futures are trading with assumptions that delivery will happen smoothly, that premiums will stay normal, that the metal is there when you need it. That assumption is breaking down in real time. Now let me show you what very few people are talking about. When delivery stress shows up across regions at the same time, it stops being a local dislocation and starts becoming systemic. You've got North America seeing premium spikes, Europe's got delivery delays, Asia's bidding aggressively. That's not 3 separate stories. That's one story playing out globally. And when you see that pattern, you're looking at supply fundamentals overwhelming paper positioning. The paper market can suppress price through leverage and selling pressure, but it can't manufacture physical metal. It can't make refineries work faster. It can't make mines produce more overnight. There's a hard limit to how long paper can diverge from physical before something breaks. We might be watching that breaking point happen right now. Zoom out with me for a second, because this isn't new behavior. It's just rare. This is the same playbook we saw in the late 1970s when physical demand overwhelmed paper pricing. Silver went from under $10 to over $45 in less than 2 years. What happened next? Exchanges changed margin requirements, forced liquidations, and eventually the paper market regained control. But not before people who held physical metal saw massive gains. Same pattern we're seeing today. It showed up again in 2011 when silver ripped to nearly $50 and exchanges scrambled with margin hikes to cool things down. What was driving it then? Physical buying from retail investors, supply concerns, and a flight to real assets during monetary uncertainty. Sound familiar? And more recently, you saw echoes of this in nickel in 2022, when physical shortages blew up futures overnight. The London Metal Exchange had to cancel trades, suspend contracts, and basically rewrite the rules because the physical market made paper pricing impossible to maintain. Every time this happens, the pattern is the same. Physical premiums lead, delivery times stretch, inventories drain, then price follows, often violently. When you zoom out, the larger story isn't volatility, it's credibility. Markets only function when paper reflects reality. When it doesn't, trust erodes fast. And once that trust breaks, capital moves quickly. You get forced repricing, delivery failures, and eventually regulatory intervention. We've seen it before. We'll probably see it again. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this gap close quickly? Absolutely. Could exchanges raise margins, change rules, or force liquidation? Yes, and they've done it before. We just talked about it. Could China's premium compress if demand cools or if they secure enough supply? Sure, it's possible. Could this whole move be manipulation or orchestrated by large players? Maybe. But here's the thing. It doesn't actually matter whether there's some coordinated effort or some whale-moving markets. The mechanics are what matter. You don't control interventions. You don't control headlines. You don't control what exchanges decide to do with margin requirements. You control what signals you watch. Physical premiums, backwardation, delivery volumes, refinery constraints. Those tell you the truth long before price does. Focus on what you can measure and what you can act on. Everything else is noise. There are probably 3 types of people watching this right now. Maybe you're already positioned. You've been holding silver, maybe stacking physical, maybe trading futures, and you're wondering if this is the blow-off top. Should you take profits? Should you hold? Should you add? If that's you, your job isn't panic or euphoria, it's risk management. Understand margin risk if you're leveraged. Understand liquidity risk if you're trying to exit at peak prices. And don't confuse a structural trend with a straight line. Markets don't go up forever, even when fundamentals are strong. You need to know your exit plan and your risk tolerance before emotion takes over. Maybe you're silver curious but not involved yet. You've been watching from the sidelines, trying to learn, maybe kicking yourself for not buying earlier. That's valid. Your edge is patience. This move might keep going, or it might correct hard. Either way, your job is to learn how these gaps form, so next time you recognize them early, instead of chasing headlines. Study the patterns. Watch how physical premiums move relative to paper. See how refineries signal stress. Understand how regional pricing diverges. That education is worth more than chasing one trade. Or maybe you're skeptical of the whole thing. You think this feels overhyped, maybe manipulated, maybe just another bubble that'll pop and leave bag holders. That perspective matters too. Skepticism keeps you honest. Just remember, disbelief is expensive when structural deficits meet real-world demand. You don't have to be a believer to respect price action and supply dynamics. The universal principle here is simple. Follow the flow of physical metal, not the noise of price ticks. Whether you're bullish, bearish, or just watching, that principle keeps you grounded. So here's what I want you to answer in the comments. Which one are you? Are you positioned and managing risk? Are you learning and waiting, or are you skeptical and watching from the outside? Tell me where you stand because I want to know who's watching this with me. Here's where I stand. I'm not screaming to the moon, and I'm not dismissing this as a blip. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching whether Western spot prices are forced to reprice upward to chase physical supply. If we see London and New York spot prices start climbing toward Shanghai levels, that would indicate the paper market is capitulating to physical reality. That's a massive tell. Second, I'm watching vault inventories and delivery delays. That's where stress becomes visible. If COMEX inventories keep draining and delivery times keep stretching, the mechanics are confirming what price is telling us. Third, I'm monitoring China's premium. If that stays elevated or widens further, the message is clear. This move wasn't emotional, it was mechanical. Based on my analysis, this event was structural, not just technical noise or short-term speculation. The fundamental picture hasn't changed. It's been building for years through supply deficits, industrial demand growth, and paper market overpositioning. What changed is that the gap between paper promise and physical reality got too wide to sustain. The fundamentals aren't breaking down. They're asserting themselves. If history rhymes and silver continues following the physical premium higher, the move that follows could dwarf what we've seen in the last 48 hours. I'm not making predictions. I'm watching mechanics. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at Shanghai premiums. Look at refinery announcements. Look at COMEX inventories. Don't take my word for it. Make your own decisions based on your own risk tolerance and your own analysis. If you made it this far, you're the kind of person who wants to understand markets, not just react to them. That mentality will serve you well. Share this with someone who needs to see it. Subscribe if you want more analysis like this. And stay ahead of the headlines by watching the signals that matter. Think critically, verify data, and make your own decisions. Stay sharp out there.